So you're divorcing a federal employee in D.C., or maybe you're the employee yourself. You need to know, this is not your standard divorce. There are very specific, very strict federal rules you have to follow. And honestly, getting them wrong can have huge consequences for your financial future.
And let's be crystal clear about this from the start. The federal government will just flat out reject standard state court divorce orders. This isn't a minor hiccup. It's the kind of mistake that can completely derail your entire financial settlement. So yeah, your security really, truly depends on knowing these unique federal rules inside and out.
So in this explainer, we're going to lay it all out for you. We'll walk through the 5 key benefits that absolutely have to be divided. We'll talk about the specific court orders the government demands. We'll cover what happens with health insurance, which is a big one. And we'll highlight the deadlines you absolutely cannot miss, plus 3 really costly mistakes you'll want to avoid. Okay, first things first, let's dig into the 5 major benefits that are on the table. For a lot of couples, these federal benefits are by far the biggest assets in the marriage. We're talking about things that can be worth hundreds of thousands of dollars over a lifetime.
Here's the lineup. You've got the FERS or CSRS pension. That's the monthly retirement check. Then there's the Thrift Savings Plan or TSP, which is basically the federal version of a 401k. Of course, there's the Federal Employee Health Benefits, the FEHB. You also have survivor benefits, which are crucial. And finally, the Federal Employees Group Life Insurance, or FEGLI.
Let's focus on the pension for a minute. When it comes to dividing it up, the court doesn't just pull a number out of thin air. No, a former spouse's share is figured out using a very specific, time-based formula that calculates exactly what chunk of that pension was earned during the marriage. And here's the formula itself. It's actually pretty simple when you break it down. You take the number of months of federal service that happened during the marriage, that's the top number. You divide that by the total months of federal service when the employee finally retires. That gives you a fraction, and that fraction is the marital portion of the pension that gets divided up. Now, this brings us to a really important question, and it's something that trips up a lot of people. For the former spouse, when did those pension checks actually start showing up in the mail? And this is the key difference. With most private sector pensions, a former spouse can often start getting their payments as soon as the employee is eligible to retire, even if they're still working. But not with federal pensions. The payments for the former spouse will start only when the employee actually retires and applies for their benefits. The employee cannot be forced to retire. That's a huge distinction. Okay, let's talk about the legal paperwork itself. In this next section, we're going to cover the very specific court orders you need and get into exactly why the standard documents most people use in a divorce just won't cut it here. Here's the bottom line. If your lawyer drafts up a standard QDRO, that's a Qualified Domestic Relations Order, to split a federal pension or TSP, it's going to be rejected. Period. It is simply the wrong tool for this job. So what do you need instead? For the pension, it's something called a Court Order Acceptable for Processing, or a COPE. This is the official document that the Office of Personnel Management, OPM, requires. And it has to be perfect. It must use precise, federally approved language, right down to the last comma.
This chart really spells it all out. You see, federal benefits are governed by Title V of the U.S. Code, not ERISA like private plans. The court order you need is a COAP for pensions or an RBCO for the TSP, not a QDRO. And you're dealing with federal agencies like OPM, not some private company's plan administrator. They are 2 totally different worlds. All right, let's switch gears to a topic that's a huge source of anxiety in any divorce: health insurance. Let's look at your options for continuing that Federal Employee Health Benefits, or FEHB, coverage. You've basically got 2 main paths here. The first is called Temporary Continuation of Coverage, or TCC. That can last up to 36 months. The second, and often much better option, is through the Spouse Equity Act, which can give you lifetime coverage. But there's a catch. To qualify for that, you must be awarded a portion of the pension or a survivor annuity in your divorce. Okay, I want you to pay very close attention to this number, 60. You have exactly 60 days from the date your divorce is finalized to apply for either of these health insurance options. I'm not kidding, this is not a suggestion, it's a hard and fast deadline. If you miss it, you permanently lose these rights. It's that critical. This brings us perfectly to our next section, which is all about those crucial deadlines and actions you need to take. Think of this as your personal checklist to make sure you're protecting every single benefit you're entitled to. So if you want to apply for that incredibly valuable spouse equity health coverage, you have to follow these steps to a T. Get a certified copy of your divorce decree. Find the part that proves you were awarded a piece of the pension or a survivor annuity. Get the employee's info, name, birthday, social.
Then you package all that up and send a written request to OPM. And there it is again. Step 5, all of this has to be done within that 60-day window.
Now, a quick word for the federal employee going through the divorce. This slide is for you. As soon as that divorce is final, you need to update these 4 beneficiary forms immediately. We're talking about the forms for your death benefits, your TSP account, your final paycheck, and your life insurance. If you don't do this, your assets could automatically go to your ex-spouse, not to the person you want them to go to.
And finally, let's wrap up with the 3 most common and, frankly, most expensive mistakes people make. These are the kinds of small slip-ups in paperwork or timing that can mushroom into huge financial losses later on.
Mistake number 1, and we've talked about this, is trying to use that QDRO language. OPM will just kick it right back. The real pain here is that you might not even find out about the mistake for years. Then you're forced to go back to court long after the divorce is over just to fix the paperwork. It's an absolute nightmare, legally and financially.
Mistake number 2 is just waiting too long. If you wait until the employee retires to send in the court orders, you are just setting yourself up for a massive, massive delay. OPM's processing time can easily take more than a year. Think about that. The former spouse could be waiting over a year after retirement to get their very first check, all because the paperwork wasn't sent in early for pre-approval. And mistake number 3. This one might be the most devastating of all. It's not securing a former spouse survivor annuity in the court order. Let me be perfectly clear about what that means. If that's not in your divorce decree and the federal employee passes away first, your pension payments stop. Just like that. Forever. The income is gone and you also lose your eligibility for that lifetime health insurance. It's a total loss.
So when you put it all together, what you're dealing with is a really unique legal puzzle. A federal divorce in D.C. isn't just family law. It's this complicated mix of local D.C. law, incredibly dense federal regulations, and the rigid black and white procedures of government agencies. And that really leaves us with this one last question to think about. Your retirement security, your pension, your TSP, your health coverage, all of it, could easily be worth hundreds of thousands of dollars. So you have to ask yourself, is the legal strategy you have in place actually built to handle all the specific demands of these federal regulations?